Welcome to the launch webinar for the Swiss Sustainable Investment Market Study 2020. It's now 11 o'clock Swiss time. We will start the webinar in a minute to give all participants the time to join us. We have already over 100 participants, but expect some more to join us throughout the next minutes. Thank you for being with us already. I would now like to welcome all of you to this SSF launch webinar for the Swiss Sustainable Investment Market Study 2020. My name is Sabine Döbeli. I'm the CEO of Swiss Sustainable Finance, and I will guide you through today's webinar. We are very happy to welcome so many participants and much look forward to presenting you the key findings of our study. It's the third market study we prepared jointly with the Center for Sustainable Finance and Private Wealth at the University of Zurich. Before we start, let me just quickly inform you about some technical aspects of today's webinar. All participants are on mute and without video. We do have the Q&A option active though, and we encourage you to use it. We will do our best to answer as many questions as possible. If you should have any technical issues, you can also tune into our YouTube live stream. You just go to the SSF YouTube channel and put a /live and can then watch it on YouTube. And the recording of the event and the presentation will also be available online after the event. Let me now briefly go through the program and introduce the different speakers to you. First, we will hear two welcome notes, one from our president, Jean-Daniel Gerber, and one from Falco Petzold, Managing Director of the Center of Sustainable Finance and Private Wealth at the University of Zurich. Then Kelly Hess, Director Projects, and Jean Laville, Deputy CEO of SSF, will present you the findings of the market study. And then Anja Bodenmann, Project Manager at SSF, will follow with an overview on regulatory developments. I am happy to now hand over to Jean-Daniel Gerber for a brief welcome note.
Thank you, Sabine. Ladies and gentlemen, I'm also delighted to welcome you to today's webinar on a topic that is close to all our hearts and for which we most likely all agree. It is not an opinion, it is a must. Sabine Döbeli and her team will present the latest Swiss Sustainable Investment Market Study. I think we can proudly say that this is the only publication providing reliable data on the Swiss Sustainable Investment Market. I don't want to reveal anything in advance, but I can already confirm that SSF's great commitment is obviously bearing fruit and that we have moved forward regarding the objective that we all share, the promotion of sustainable investments, with record figures achieved in the period under review. But it is also clear that we have not yet reached the end of the path and the way to a sustainable financial center. There are still various barriers to overcome and uniform standards to be defined. It is natural for SSF to have an ambitious vision for a sustainable Swiss financial center, which for some industry players may be challenging. Yet, the need to rethink and reorient the global economy in light of the climate crisis is undisputed. This is where the financial industry can and must make an important contribution. It is increasingly doing so already, but we are not yet satisfied with what we have achieved so far. Building a sustainable financial industry is an obligation, and all players must start acting together. SSF is committed in this and actively seeks a dialogue with all relevant actors. At the same time, there is growing pressure from the political side, especially on the financial industry. In the near future, the European Union will introduce new transparency requirements that will help to further grow sustainable investments. SSF welcomes this development, and we hope that the announced regulatory requirements will serve their purpose and not be ineffective. Personally, I believe that the European initiative comes at the right time and the right moment and will contribute to a better understanding of the different sustainability approaches by investors. Clarity and truth are key to the further growth of sustainable investments. And this is in the interest of all of us. I would like to conclude my remarks with a quotation from the eccentric Salvador Dali, who once stated, rightly so, "Intelligence without ambition is a bird without wings." In this sense, I'm very confident that our wings, our ambition, will carry us further. My confidence is also based on the great encouragement we are receiving from all of you. I'd like to thank you for your commitment and your valuable contributions to sustainable finance. Thank you. Sabine, I give you back the floor.
Thank you, Jean-Daniel, for this welcome from the side of SSF, and good to hear that you think that SSF, through its activities, is helping to shape the Swiss Sustainable Financial Center. I now hand over to Falco Petzold for a brief welcome from the side of CSP.
Thank you very much, Sabina. And once again, also congratulations to the whole Sustainable Finance Switzerland team for this very, very important effort, this very important report that I think is so crucial for all of us to have the transparency about the development in the Swiss market that is really essential for all of our work. Now, thank you everybody also for joining today's introduction of this report. Maybe let me share 3 observations that I find fascinating with this report here in particular. The first observation is really regarding the development of the sustainable finance market overall, as we also documented here in this report. What we see is that the growth of this market really, again and again, every year is exciting and is tremendous in types of growth in assets under management. That is very much encouraging. What I personally also find very interesting is how private investors actually also are more and more engaged in sustainable finance, as we see also here, and the strong growth of assets under management in relation to private investors in particular. I think that's a very interesting development overall. Also, of course, what's fascinating to see in regard to sustainable finance overall is, of course, the strong engagement by regulators. And I believe we'll dive into that more in this webinar as well. Now, the second observation that I find fascinating that comes through also in this report is more regarding the individual sustainable investing strategies or approaches and how they're actually applied by market players. We like to think that basically sustainable investing has gone through 2 phases in the past and is now moving to a future phase. In the past, of course, where sustainable investing comes from in particular was exclusion criteria. This is where the whole field came from, and then moved sort of throughout the 80s, 90s, 2000s to a second phase, which was more about integrating ESG data, environmental, social governance data, and really thinking through how to integrate this data into investment processes to cover risks and also to explore opportunities. Now, what we see in particular in this report here is, I think, a move into a third phase in the sustainable finance space in regard to sustainable investing strategies, which is really more thinking about the actual impact that investors really have. So what I mean is that in this report in particular, we see that there is tremendous increase in assets under management, in particular in the approaches of ESG voting and ESG engagement and in regard to impact investing. So I think what we really document here is an increased shift from not only, of course, the integration of ESG data, right? This was sort of the second phase of this market, but now really also, in addition to that, an increased focus on more impactful approaches. And that leads me to my third observation that I find fascinating is that I think what we see more and more also in society more broadly in regards to the COVID-19 crisis is a more strategic thinking about how we can actually have impact through whatever tools we as individuals or institutions have at our hands. And of course, in regard to the sustainable finance audience here in this webinar, that is through investing. And that is, I think, a very interesting and important development that we see that in particular also now investors are really thinking more strongly about not only how they can cover risks, etc., but how they can really have an impact, be strategic about that. And of course, also maybe an increased focus on actually integrating scientific evidence into doing that. And with that, I would like to hand back to you, Sabine, to have the whole team also walk us through the detailed findings. Once again, congratulations to this important effort. And I think it really documents nicely those really important movements in the market, real growth, more focus on impact, and I think also more of a strategic focus now by investors about having impact and integrating science and data, etc. Thank you.
Thank you, Falco, not just for your comments, but also for the very fruitful cooperation we had with CSP in the preparation of this year's study. But now we want to dive into the details, and I give the word to Kelly Hess for the presentation of the key findings of this year's study.
Thank you, Sabina, and thank you also from my side to all those who are joining us. I would also like to thank all those who participated in the study, providing us the data to produce this report. With our deadline for submission actually in mid-March, we were extremely thankful to have a stable participation, even though the situation at the time was most likely very challenging. So on a very positive note, this dedication was a signal from the market showing us the importance of the topic. This year, we had close to 80 total participants, similar to last year, with about 60% banks and asset managers and 40% asset owners. For the study, we looked at all volumes applying one or more of the 8 commonly accepted SI approaches. This year, as Falco mentioned, we have reached another level. We have breached the 1 trillion Swiss franc mark. So by the end of 2019, volumes grew to 1,163 billion Swiss francs. This was a 62% increase from last year. The strongest growth was from asset managers, with funds seeing an increase of 147% and mandates of 195%. We saw much less increase from asset owners. However, this was mainly due to the fact that we had significant corrections to volumes reported of a few participants. So if we had calculated ignoring these outliers, we would have expected actually a growth of 45%. Overall, there were 3 main contributors to growth that we saw. First of all, a wider adoption of ESG approaches to existing assets, as well as inflows into SI products. Secondly, the positive market performance, of course, of 2019, which accounted for about 18 percentage points. And thirdly, due to a methodology change we had this year, we collected data on the level of funds and mandates only. We looked at all funds and mandates that applied one or more of the named sustainable investment approaches, and we no longer looked separately at assets linked to company-wide policies. So this led to higher volumes reported under the funds and mandates category. The figures illustrate that sustainable investments are now mainstream. Sustainable funds now account for about 38% of the total fund market. Sustainable assets managed by institutional asset owners account for 30% of their total assets. And we can therefore roughly estimate, based on latest figures available, that the total sustainable assets in Switzerland correspond to about a third of all assets managed in Switzerland. And the question we raise every year is actually, well, what level of sustainability is behind these assets? But we touch on this point a little bit later in the presentation. So first, let me outline some of the key observations with regards to the total volumes. When we look at the breakdowns between volumes held by private versus institutional investors, we see that there was a shift in the distribution this year. Last year, institutional investors represented 88% of the volumes versus 12% held by private investors. What we saw with the reported volumes this year was a big jump in the volumes for private clients. So this segment experienced growth of 185% and now accounts for 21% of the total volume. We believe the reason for this is twofold. On the one hand, providers continue to integrate sustainable investment approaches across their full asset ranges, hence improving the supply of sustainable investment products. And on the other hand, we see increasing demand from private clients for such investment solutions. And this observation also holds true for institutional investors. Although the proportion held decreased, sustainable assets held by institutionals did increase in absolute terms with a growth rate of 46%. Another observation from the data supports the mainstreaming evolution taking place. As you see here, last year, most asset managers, or about 17, reported having 20% of their volumes managed sustainably. This year, that picture actually looks completely reversed, with the highest number of respondents reporting having above 90% of their assets managed sustainably, and the lowest number reporting having below 20% of their volumes managed sustainably. So for us, this is a clear signal that also non-specialized asset managers continue to further apply sustainable investment approaches to their broad asset base. So as I mentioned, when we refer to sustainable investing, we are specifically referring to the application of one or more of the 8 commonly accepted SI approaches. And here you see the development in volumes of assets linked to each of these approaches. And keep in mind that multiple approaches can be applied to the same assets. Overall, growth was observed for every approach. ESG integration and exclusions still land on place 1 and 2, just like last year. But one important change was that ESG engagement moved up to the 3rd rank. This year, something particularly interesting was that, as Falco mentioned, the 3 approaches, ESG engagement, ESG voting, and impact investing, showed the highest growth rates, all triple digits. And what we interpret out of this is that we are moving into this kind of 3rd phase of sustainable investing. Just to repeat quickly, we think that the first phase was really the origins, where mostly exclusion approaches were used, and the second period where priority was placed on implementation of a sound internal sustainability process, and now to this current phase where investors really put the focus on outcome-oriented approaches. And ultimately, they want to measure and communicate about these real-world effects. So you might raise the question if all these assets have a positive outcome or impact. Well, one thing is clear, the discussions around how to define outcomes and impacts are far from over, and we see the need for further clarification to make these effects measurable and transparent. So for instance, if you look at the high growth in impact investing, the bottom bars, if we look deeper in the data, we know that the volumes are linked to different asset classes, both listed and unlisted instruments. So here especially, it is important to be able to differentiate between products and also asset classes that have high versus low impact or direct or indirect impacts. And there are currently numerous industry efforts underway tackling this issue. So we at SSF follow the developments in this area closely, and we've already taken up this topic within many of our active working groups to bring more clarity to our network. So moving on to some of the new elements that we implemented this year, based on a lot of the input from our work group, which every year helps us identify new areas to explore and assess, we implemented a few new aspects into the survey. One of these was specifically for asset managers. We wanted to know how many of their sustainable assets were linked to products officially marketed as sustainable products versus those that are not officially marketed as sustainable. These results you see in the left figure. What we saw for funds and mandates was that the majority, or 3/4 of assets, are not specifically marketed as sustainable, although they apply one or more of the defined sustainability approaches. Another interesting new topic was labeling. Here we also asked if the volumes reported were linked to any third-party certified label, for instance, the F&G label or Lux flag. With 6%, only a minority of the funds have a third-party certified sustainability label. However, we also know that aside from labels, a large number of asset managers, Swiss asset managers, apply the European SRI Transparency Code to their various funds, and therewith provide detailed insights into their applied methodologies. We feel that from the side of private clients, there is demand for more orientation through the use of labels to identify suitable products based on their own sustainability viewpoints. It is definitely a discussion that will have to be led in Switzerland, also considering the developments from the side of the EU, which is currently developing an eco-label based on the EU taxonomy, and calls from different stakeholders for more transparency around SI products. This year, another new aspect of the study was to take a closer look at how participants use the various SI approaches, sustainability approaches, in combination with each other. Each of the 8 approaches have a different focus and can therefore be applied based on specific investor motivations. From selecting the best and worst sustainability performers, normally by using best in class versus an exclusion technique, to risk return motivations, often linked to the ESG integration approach, all the way to influencing change linked to engagement and impact investing. But to achieve multiple goals, different approaches have to be combined. But we don't necessarily correlate higher quality with a higher number of approaches, but we do think there are useful and effective combinations. For instance, we often see ESG integration, which is used to minimize risk, combined with ESG engagement to generate desired outcomes with investee companies. Such a combination can definitely be seen to improve the sustainability effect of such products. So wanting to offer more details on these combinations and look at the sophistication and quality of SI volumes, we aggregated volumes linked to the different combinations of the approaches. And now we'd actually like to run a quick poll for the audience. I hope you're all seeing the poll pop up on your screen. We had to run this exercise within the SSF team in order to implement this new analysis. And it wasn't a trivial task. So the question is, if you have these 8 combinations, what are the number of possible, if you have these 8 approaches, what are the number of possible combinations that you could actually end up with? So I see the results coming in right now. I'm just going to give it a few more seconds that everyone gets a chance to vote. Okay, and it seems like the vast majority chose the option of 8 factorial, which is it's actually something, a trap that we fell into too, but actually the answer is 2 to the 8th. So there were 256 different approaches that we had to look at and aggregate data for. And maybe we can look at mathematics later. So great. So luckily, not all of those 256 combinations were applied in practice, which made the aggregation easier. what we saw is that over 80% of the total volumes applied a combination of 2 or more approaches, and over half use 3 or more. So only 17% limit their sustainability consideration to only one approach. We see this as a clear sign of increasing sophistication in the Swiss sustainable investment market. So now let's take actually a deeper look at the frequently applied combinations. Here you see that we've abbreviated each approach using a 2-letter code. So for instance, best in class was abbreviated to BC, ESG engagement with EN, and you can use these codes to interpret the graph. Looking at the total sustainable investment volumes within the top 5 combinations applied, ESG integration was present in 4 of these, one of them being the application of ESG integration as a standalone method. And just as a side note, we may actually soon see that in the EU, for instance, such assets, those based purely on ESG integration, will no longer be considered sustainable going forward based on current political discussions. So from this analysis, we can get a better idea of the blocks of volumes that perhaps go a bit above and beyond when it comes to sophistication and quality. If you look at the first bar on the left, you see that 156 billion apply exclusions and ESG integration together, while if you move to the second most popular combination, there you see that they add some additional layers using norms-based screening and also the outcome-focused ESG engagement approach. Approaches applying very strict filters, such as thematic and impact investing, don't appear in any of the top 5. And this is partly due to the fact that although perhaps there is a very strong sustainability focus, these are more specialized and often have the form of satellite investments, especially for institutional asset owners. So with this new analysis implemented this year, we hope to continue to collect insights on how and why market players apply the different approaches in the various combinations and better understand how the market is evolving. So now to present the special topic of climate change and market opinions, I hand over to my colleague Jean Laville, Deputy CEO of SSF.
Thank you, Kelly. Ladies and gentlemen, nobody can argue today that climate change consideration are and must be a top priority for our society. Financial players are also becoming more and more aware of their role and how they can contribute to positive impact in this area. For the study, we asked asset managers what measures they already have in place to address climate change within their investments. 91% answered that they, in one form or another, measure the carbon footprint of some of all of their portfolios. This is a positive sign, as this means that almost all asset managers have started to measure their footprint, and what you measure, you can manage. Therefore, we expect to see more market players coming out with strategies to report and, in the end, reduce the carbon footprints of their portfolio. Also high on the list with 85% of respondents were investment in climate solutions. Further down, with 68% was engagement on voting on climate change. Here we see a lot of room for more asset managers to become active. We also expect this to increase due to the activities on multiplying factors of various initiatives. For instance, with the 450 strong investor initiative, Climate 100 Plus, which will continue pressure on the largest fossil fuel emitters. Linked to this topic, we also look at progress being made with respect to recommendation issued by the Task Force for Climate-Related Financial Disclosure, TCFD. These recommendations were first released in 2017 and have now become a mandatory part of the PRI reporting. Additionally, some of what the EU has put forward in its action plan have integrated aspects of the TSF recommendation. Therefore, it is important that market players start to understand and apply this recommendation where possible. Only 4 players answered that they already published reports aligned with TCFD. However, half of the respondents claim they do not report and have no plans to. So there seems to be a split market in Switzerland. With TCFD increasing importance, SSF will be working on a report partly focusing on helping investors understand how to report align with TCFD recommendation. So we hope here to have an influence. For now, the next step of this report is about drivers and barriers. And this purpose of the study is to identify key barriers and drivers for the further growth of sustainable investing. For asset manager, client demand and legislative pressure are perceived as the most important drivers. For this reason, it is important for the industry to make sure client advisors are adequately trained to be able to offer appropriate products. This is why SSF has recently publicly launched a free access to our e-learning modules on sustainable investment. Asset managers perceive a lack of standard now as a top barrier. Previously, on the top of the list was the lack of conviction of client advisors, which seems to have been partially overcome over the last few years. For asset owners, political pressure and pressure from the board were ranking highest on the key drivers for asset owners. It is obvious that asset owners will increasingly feel pressure from the political side as governments are taking up the topic more seriously. On the barrier side, for asset owners are financial topics, namely performance concern and concern regarding higher costs. This is definitively a sign to SSF that our work is far from over when it comes to communicating on this to asset owners. One thing to note, during the COVID-19 crisis, sustainable funds on average demonstrated lower volatility and losses, and it may be a factor that helped change the mind of such investors. As a conclusion, SSF will continue to monitor key barriers and drivers, which will also help us to define next important point of action. With that, I would like to give the word back to Sabine.
Thank you, Jean and Kelly, for these detailed insights into the study results. I now pass on to Anja Bodenmann, who will give you an overview on the many regulatory developments we've seen emerging over the past year. Thank you, Anja.
Thank you, Sabine. As my colleagues Kelly and Jean have already pointed out, a strong driver for the continued growth of SI are developments in the regulatory sphere, and I'll give you a brief overview on these developments in the next 10 minutes. We see on this chart that in the past decade, there has been a clear proliferation of sustainable finance regulatory measures. It's not always strict regulation, but just measures and policy developments in general. So the question at the start of this new decade is no longer whether governments will become active in the sphere of sustainable finance, but what policies they will use once they do so. What we have noted is that policymakers are increasingly trying to develop comprehensive sustainable finance strategies, and policy measures are maturing, becoming more concrete, and they're ultimately trying or being used to support the macro sustainability goals of governments. The most prominent example of this very extensive and fast-paced approach is the measures that the EU is taking. And being in Switzerland, we obviously cannot and do not ignore what is happening there, because for many Swiss actors with cross-border activities, EU rules are very relevant. So to recap what happened on the EU level in the past year, the EU has finalized practically all draft legislation proposed under its action plan. The action plan on financing sustainable growth was a package of measures proposed in 2018, and now, a mere 2 years later, it has already led to 9 legislative and 19 non-legislative measures. First pieces of these measures are being adopted and put into legislation. The most prominent piece of the package is the taxonomy, which I assume many of you have heard of. The taxonomy classifies what economic activities can be considered sustainable and serves as a classification system for financial products too. With the taxonomy, the EU set a fundamental basis for future sustainable finance regulation. But at the same time, it's also already working on technical details around these measures. For example, the EU supervisory authorities, the main ones being ESMA, EBA, EIOPA, have already launched an open consultation on EU disclosure standards. So we see that we're getting more to the details here. Even with this first package of measures presented, the EU does not show signs of slowing down anytime soon and has already announced a renewed sustainable finance strategy to follow up on the action plan. Finally, this is the last point on this slide, the EU also created an international platform to foster exchange and policy convergence around sustainable finance. It's called the International Platform on Sustainable Finance and was launched last October. Switzerland also became a member of this very important initiative, and we hope that this will help achieve some sort of transnational policy consensus so that in the end, the industry isn't confronted with a multitude of diverging definitions and expectations. It's of course not just the EU, but governments all over the world that are making clear commitments to their sustainability targets. In Switzerland, for example, the Federal Council set a new and ambitious climate target last year, net zero 2050. And with regards to the financial sector, Federal Councillor, now President Simonetta Sommaruga, stated that Swiss investors must ultimately have an investment behavior that does not torpedo our measures to achieve the Paris Agreement. Therefore, it doesn't come as a surprise that also in Switzerland in the past year, we witnessed quite a lot of movement. And I'll briefly go through the most important elements. The Swiss government on one side has created an internal and also external working groups on sustainable finance, addressing, for example, the topic of transparency or fiduciary duty. SSF and also other industry associations are part of the external working group. And here it's important to mention that the Swiss government continues to give priority to market solutions and has also created participatory processes for the industry to voice its opinions and what it sees as a way forward. Switzerland also joined major international initiatives and forums. I mentioned the EU's international platform, which Switzerland joined. Also very important is the Network for Greening the Financial System. This is a forum of about 40 central banks and supervisors with the aim to share knowledge and better understand the potential impact of climate risks and financial stability. And FINMA, the Swiss Financial Market Supervisor, and the Swiss National Bank became members of this very important network last year. Another activity promoted and initiated by the Swiss government are the PACTA climate tests. This is a voluntary test that lets asset owners and now also banks and other asset managers screen their portfolios against different climate scenarios. PACTA is already taking place for the second time, and we expect to have results this fall. Now turning to the legislative side in Switzerland. At the moment, there's only a handful of existing law that pertains directly to sustainable finance, but we do see a lot of uptake in the Swiss parliament. A new parliament was actually elected last autumn, 2019, and the Green Party made considerable gains. But already before the new parliament met for the first time, which was in December, there was a lot going on. And in total in 2019, there were 28 parliamentary items of business submitted on the topic and on various aspects related to sustainable finance. Another important item on the parliamentary agenda is the current revision of the Swiss CO2 Act. Now, although the CO2 Act is not financial regulation per se, it includes 2 references to the financial industry. And it's actually being debated in Parliament this week. So we'll expect to see if anything changes or if it's passed this week. Now, to wrap up on developments in Switzerland, of course, industry initiatives and market-driven action is a very strong enabling factor. Major finance associations have in fact helped mainstream the issue, and this is reflected in the numbers presented earlier. by my colleague Kelly. Two concrete and very recent examples of what the industry is doing here is the joint work group by SFAMA, this Swiss Funds and Asset Management Association, and SSF, which are working on guidelines on sustainable asset management together, and these guidelines will be released next week. Another example are recommendations released by Swiss Banking last week. Now, finally, also, of course, internationally, there are multiple industry-led forums that are developing best practice, and governments often build on these too when they sketch out their policy. There's many broad sustainable finance initiatives that reunite a large number of actors, the most famous probably being the PRI. But I'll go into a more recent initiative, which is the Principles for Responsible Banking. They were launched last September at a UN summit, and they set clear impact measures for the targets for their signatories. On the climate side, we have the recommendations made by the Task Force on Climate-Related Disclosures, which my colleague Jean went into detail. And the interesting thing here to mention is that the TCFD recommendations are being taken up by a number of countries. For example, we read about 2 weeks ago that in Canada, companies filing for COVID-19 bailouts are required to file TCFD reports. Another, of course, there's many initiatives also in the field of climate, but an important one founded last year is the Net Zero Asset Owner Alliance, a group of institutional asset owners that defined a clear reduction target to transition their portfolios to net zero emissions by 2050, and also reunite a number of large Swiss asset owners. Finally, I just want to mention that also on the social level, there are two international guidelines that set important standards. It's the UN's Guiding Principles on Business and Human Rights, and also the OECD guidelines for multinational enterprises. Now, these guidelines are not just relevant for the financial industry, but it's interesting to note that for the OECD guidelines, they have a complaint mechanism in the form of national contact points. And this complaint mechanism is also increasingly being utilized to file complaints against financial institutions. So to conclude, we see that all these regulatory developments have helped develop the Swiss SI market to where it stands today. And we don't expect regulatory action to cease anytime soon. However, we also note that with this increased regulatory activity, the financial sector is facing increased complexity, and also aligning all these developments will probably be the biggest challenge for the next decade. So with that, I hand back over to Sabine and Kelly. Thank you.
Thank you so much, Anja, for that overview. Before we go to our final slides, we have one last poll to gauge the opinions of this virtual room. So you should soon see a poll popping up. We asked this same question to all the participants of our study. What is the growth of sustainable investments you expect in 2020? So if you could all just type in your responses now, and I'll just give it a few seconds. Do you expect it to be negative, to stagnate, or growth of up to 15%, 15 to 30%, 30 to 50%, or over 50? And it seems like, so I'll take a screenshot now, it seems like most of you have the opinion that we will be seeing growth between 15 and 30% in the next year, or this year, basically. That is actually quite in line with what we saw from the participants this year. For asset managers and asset owners, we saw that most said that growth will be positive and somewhere between 15 and 30%. So it seems like the opinions in this virtual room are quite aligned with those who participated in our study. And therefore, there's definitely a lot of optimism about the growth of sustainable investments in the future. So thank you so much for your active contribution to our polls. And now I'd like to hand it back over to Sabine for some concluding remarks and the Q&A.
Well, thank you, Kelly, for closing with such a positive outlook. And I would like to briefly summarize the key takeaways from our study. I will keep it short to also leave some time for our discussion. I think we could clearly show that sustainable investments have reached the mainstream, And in this movement, ESG integration is right now the dominant approach, although in most cases it is combined with other approaches, something that we consider as important, as the discussions on the EU level clearly go in the direction that ESG integration alone will no longer be considered a sustainable investment approach. We clearly saw that private investors have gained shares, but we also see that exactly these private investors call for clearer definitions and standards. They feel they want more orientation as to what such sustainable funds actually reach and achieve in the real economy. And this is definitely something that we all need to work on. I think it was already mentioned by Falco at the beginning. We did see a lot of growth for more outcome or impact-oriented approaches. And it clearly leaves us with the question, are we entering the third phase of sustainable investing? Our opinion is, yes, we are. There is more call for impact and more activity to have a true outcome with the investments, but it will also be a topic that we will have to deal with. And as SSF, we clearly want to contribute to this trend through our work. Some things we have on our desk is right now the guidelines that we are developing with FAMA. Anja mentioned them. We work on further transparency through our work groups, but we also have a study in preparation on financing solutions for a low carbon economy that will be presented after the summer break. Our ambition is clear. We want to make Switzerland a truly sustainable financial center, and we look forward to achieving this goal with the support of all of you. Now, before we go to the questions that I see have come in now, I would like to thank all the parties that were involved in the preparation of this study. The study was compiled with the help of the SSF Market Study Work Group, which allowed the methodology to be closely aligned to market needs and views. The data analysis was, as mentioned, jointly carried out by SSF and CSP. This ensured a systematic assessment of the data based on scientific principles. We would like to thank both Professor Timo Busch, who is Senior Fellow at CSP, and Nadia Detwiler for their thorough work in analyzing the data and interpreting it with us. And last but not least, I would like to thank all sponsors of the study that you see on this slide. You will, by the way, find interesting sponsor contributions on topical SI aspects in the market study. We think they offer concrete insights into current practice and related challenges, and you will maybe want to look through these interesting contributions. Thanks again to all the involved parties. By the way, you can now download the study from our website. One last comment before we address the questions. Allow me to briefly comment on the pictures you find on the cover and also in the report. We are presenting this report during a time when the global focus is on addressing the enormous challenges brought on by COVID-19. We therefore chose to concentrate on positive aspects in the illustration for our study. Actually, the report contains examples of innovative solutions brought to the market to address existing global challenges. They are all made in Switzerland, and we think they are an encouraging sign of the path to a more sustainable world. Have a look at the pictures in our report. Now, with this, we would want to move over to your questions, and I already skimmed through them before and would like to pick a first one that is on a more general level. One question is around performance. We are talking of 1/3 of sustainable investments. Do we see any evidence that the sustainable investments outperform the old world investments? Kelly, can you take this question?
Thanks, Sabine. So I know that there are many scientific studies out there that look at sustainable funds or sustainable investments compared to traditional ones. And there is definitely a lot of evidence supporting the fact that sustainable investments, maybe we can't say 100% outperform, but definitely perform in line with traditional investments. But as we're seeing now, this might also be more in focus due to the COVID-19 crisis, where we see multiple reports of sustainable investments showing lower volatility and lower drawdown during times of crisis.
Thank you, Kelly, for this answer. We then have questions related to the SDGs. On the one hand, a question that says, do we have true SDG investing, and how can we make sure that future approaches better look for making a positive contributions for the SDGs? I don't know who would want to step in. Maybe Falco, this would also be something for you, as you are working a lot with your network on these questions.
Yes, so we're actually currently running a study with private investors where we look into their approach to the SDGs. And what we find is two things. One, that about almost half of the assets from private investors that go into investments related to the SDGs go to around about 3 SDGs, usually related to housing and energy. But we also see that despite the sort of concentration upon private investors on few SDGs, investors are vastly different in regard to which SDGs they actually focus on. That. So there's great heterogeneity amongst investors in regard to the SDGs.
Thank you, Falco, for this. And then I think we have an interesting question related to new technologies supporting sustainable investments. The question is, can the blockchain technology be of support to fill the lack of standard, or maybe more the KPI measurement, as one of the key barriers to overcome this barrier actually? So I would say it's probably not so much about overcoming the lack of standards. We need standards independent of the blockchain technology, but can the blockchain technology then take a role in actually providing more transparency to investors? Who would want to take this? Maybe Kelly, you can give a first comment.
Yeah, well, what we know is that there are definitely actors looking into using more technology for the large amount of data that will likely be produced based on all the new requirements. I honestly can't say whether blockchain is the right solution for it or not. But what I obviously do think is that there will definitely need to be an aspect of improved technology to be able to kind of maybe not just store all this data in a standardized way, and also distribute this data to the various players who need to use it.
What I can maybe complement is that the Green Digital Finance Alliance is doing a lot of work around this, and is also trying to demonstrate how generally fintech can play a role in improving sustainable investment. And we've seen a pilot project in Sweden where the blockchain was used to bring information on specific renewable energy projects directly to the investors, and therewith guaranteeing that they invest in, well, infrastructure that actually exists. That's definitely an important or an interesting pilot. So maybe a more general question on blended finance. There's a question, how do you see the future of blended finance products? Maybe Kelly, you could comment on the role of blended finance within impact investing and how we see this develop.
Yeah. So for those not familiar with blended finance, this is basically a technique to pool different sources of money to be able to kind of launch products that maybe wouldn't have existed. You can kind of relate it to like development aid, but with blended finance, we more see like private actors coming together to try to achieve to either launch products that normally couldn't have been launched without the help of others. So that could be a private asset manager working together with a large corporation or something of this nature. And within Switzerland, we definitely hear some very loud voices telling us that blended finance is needed for the impact investment industry to move forward. And we definitely agree with this. We think that various actors do need to be able to interact with each other to make sure that they're using their funds very efficiently. And what we are looking into now as part of an SSF initiative together with the various impact investing and blended finance actors in Switzerland, we're looking at how to make this kind of network more efficient and really come up with a plan for a blended finance center within Switzerland.
Thank you, Kelly. Then we have a question on the progress that banks make in terms of ESG impact reporting to their private and institutional clients. Anja, maybe you could tell us about the case studies we collected in one of our work groups on this.
Yes, so we for one of the work groups on sustainable investing in private wealth and asset management, we collected different examples of how client advisors can interact on the topic of sustainability. We presented ways to bring the topic to clients not familiar with sustainable investing at all, and also ways to discuss the topic with more knowledgeable clients in that working group.
Thank you, Anja. Then we have a question on fiduciary duty. Do you see a refined fiduciary duty being legally strengthened? If we look at Switzerland, we had several reports covering this topic, clearly coming to the conclusion that it is already part of the fiduciary duty as it is well understood today in today's market to integrate ESG factors that have a financial effect. When we talk about the broader, but I don't know what exactly you mean by a refined fiduciary duty, when we talk about the fiduciary duty for impact, this is something the PRI is currently covering in a project that they do with many countries, where they look into the question if the current legislation already makes it mandatory as an investor to have a positive impact on the world. It will be interesting to see the outcome of this report. I know that for Switzerland so far, some of the legal experts that looked into the fiduciary duty did not find an indication that we can anchor this in today's legislation or understanding of fiduciary duty. So much about this question. Now, a question to Falco. What do you think could be the role of academia in the near future?
Well, thank you. That's, of course, a broad question. We think our focus is on two themes in our academic work. One is basically the decision-making of investors, and the second one is how do you actually manage impact. So on the first piece, the decision-making, I think what's fascinating here is in the study, we see this breadth of investment opportunities, right? Basically, you can build great portfolios with all types of approaches, all types of products. So that's not necessarily the bottleneck. The bottleneck is often what actually makes investors to decide to take the step to deploy assets to sustainable investing or even to increase that level of assets. And the same for advisors. So we run all types of experiments, surveys, interviews, etc., to understand better the decision-making processes and how to facilitate that. And the second piece is, of course, how do you actually really ensure that the money that is deployed actually has an impact. So we just published a paper in that regard, and I continue doing this work, also exploring further how to actually use ESG data the best, because we see that ESG ratings diverge a lot, actually, from ESG rating provider to ESG rating provider. They come up with very different ratings for the same firm. So what can you do to understand that better? That type of work is what we're focusing on. And also in applied research, quite a bit actually on blended finance, how to actually standardize blended finance approaches, etc. So I think there's a lot to be done.
Thank you, Falco. So you mentioned research on aligning ESG research methodologies. One question also relates to an ISO certification for ESG ratings, maybe the question is not quite so clear. I'm not sure if I understand it. One thing that we can say, ISO is working on a standard for sustainable finance, trying to define what does sustainable finance mean in general. As far as I know, they're not working on a rating, but I know that rating agencies are definitely also trying to get their head around how to integrate ESG factors into classical ratings, financial ratings. We do have single questions on single SDGs, for example, water. I don't think we can really dive into single criteria as this was not covered in the report, but maybe one question that could also be interesting is what approach are asset managers taking to the lack of scope 3 emission data and lack of mandatory reporting regarding such data? How should we push this agenda, or how can this agenda be pushed in Switzerland? Kelly, can you just give a general comment on scope 3 data and what the situation is right now?
Sorry about that, about the slides. Yeah, regarding scope 3 data, I mean, what we hear from at least our network is that they're quite happy with kind of the scope 1 and scope 2 data, and they are struggling with how deep they have to dive with service providers regarding data that goes deeper than kind of scope 1 and scope 2. So they've kind of called on us often to look into that with them, and we've run workshops with them with kind of outlining the different data providers and what their strengths and weaknesses are. At this point, I'm not sure if we can say we have a solution for scope 3 data. It's just very complex at the moment, and there aren't particularly any very kind of stable, or I don't know, robust answers to the scope 3 data question.
But I think what we can say is that all the discussions around TCFD reporting also bring up the question of data quality and data coverage and scope. So definitely there will be more recommendations regarding scope 3. The question is, do we need mandatory reporting on this? Right now, we don't see such calls in Switzerland, but who knows what we will see in the next months we have ahead. Now it's already 12:02. I'm sure we could go on with discussion for still quite a while, but I would not want to take more time from you. On the other hand, I would like to thank you for having stayed with us for so long and for listening to this webinar where we presented the Swiss Sustainable Investment Market Study 2020. With this, yes, it's only again for me to thank all the involved participants, to thank you for taking part in our webinar. And definitely we will be in touch again very soon with more information on sustainable finance. There are quite some projects that are being well advanced, and you will read and hear a lot more from us over the course of the summer and then also towards the autumn. So thank you very much for having been with us, and please write to us if you have any other questions that were not covered. We will try to get back to you. Thank you very much. Have a very nice rest of the day. Goodbye.